It is true, our multi-year range that we've given is 3 to 5% growth. At the moment, our markets are not growing that well, and so we guided this year to deliver between 3 and 4% growth, and that is the range that we've been delivering results in. Ultimately, stepping up our growth is about being relevant to consumers, and we know that as younger generations of consumers come through the population, businesses that conduct themselves responsibly and brands that offer choices to buy products that are sustainably sourced are more relevant, and people shift their purchasing behavior. And so in that way, by making sure that our portfolio is relevant to the younger groups of consumers coming into the economy, that will be part of our overall growth step up.
Now you've got this 20% margin target, which you reiterated last quarter during your last quarterly update. They're now just around 19%. How do you think about margins more medium term, long term? Do you think there's potential that we see further margin expansion?
If you take the last 10 years of Unilever's performance, the first 5 years was very much value creation through growth without much movement on margin. And over the last 5 years, we've seen margins expanding very, very rapidly, but with growth at the lower end of our guided range. I think when we get beyond 2020, what we'll try to do is create value with more of a balance of sustained top line and probably more moderated margin growth than we've seen over the last 5 years.
And let's talk portfolio. Some of your peers like Nestle have made some substantial moves to sell their underperforming brands, and you can make the case that if you were to do the same, it would help increase headline top line growth and also help you re-rate. So will you be looking to sell some of your major brands?
What we're doing at the moment is we're continuing our strategy of bolt-on acquisitions, and of course those acquisitions are designed to take us into higher growth spaces. We made a very major move last year when we disposed of our margarine business. We just felt that that segment was unlikely to continue to be a rapid growth area. And of course we're always reviewing our portfolio for, are there parts of it that are in structurally disadvantaged segments? And if we conclude that, then we would certainly start a process to look at those parts of the business. It would be unlikely to be brand by brand. It's more likely that we would conclude that a segment of the business was structurally in a low growth area. But we're always looking at how can we move our portfolio by adding on through acquisition and trimming off the parts of the business that are slower growth and better owned by someone else.
Now, Procter & Gamble is really firing on all cylinders now after more than a decade of losing share. Clearly, this affects you. How confident are you in your ability to fight P&G?
We are absolutely focused on our consumers and our customers. Of course, we're aware of what our competition are doing, but the highest quality growth that Unilever delivers is when we're able to trigger market growth rather than get into some expensive share battle. The fact that 60% of our business now is in the emerging markets where there's still tons of room to expand consumption is a huge advantage for us. And so we spend an awful lot of time thinking about how do we get people to enjoy the benefits of using a conditioner alongside a shampoo, or use a deodorant daily, or brush their teeth twice a day, or get better looking clothing from some of the care products that we have in our home care portfolio. That market development activity, as we call it, is a much higher priority for us than tussling over market share with one competitor or another.